All right, welcome everyone to our presentation today. As I mentioned, my name is Corinne Ferris. I am the VP of Events for Startup Experts. Ha is the founding partner of Spero Ventures and formerly Swimply CXO. She is going to share best practices on raising venture capital. By understanding how VCs think, you'll increase your chances of raising funding for your startup, especially during this period of economic downturn. Like I said, Ha was most recently Chief Experiences Officer at Swimply, where she helped the founders raise $41 million in venture capital, and she is the founding partner at Spero Ventures. She gives talks around the globe on fundraising, building and scaling startups, design thinking, and how to build products that customers love. We are so excited to have you here. I'm going to go ahead and turn it over to you, Ha.
Thanks, Corinne, and thanks, Jesse, and the Startup Experts community for having me. So before I launch into my talk, and the talk is probably about 20-25 minutes, and we'll open up then for lots of Q&A, or you can interject in between and ask Q&A. But before I launch into it, Jesse, actually, Corinne, did you say you had the poll ready?
Yep.
We launched the poll. So I'm always curious who's in the audience. So if you wouldn't mind just letting me know who you are so I can tailor some of the content specifically to you. So sometimes we have all founders, sometimes we have a mix of founders and startup leaders. And so I'm kind of curious who's in the audience with us. Okay, so we have about, at least right now, and it's going to change a little bit, about a third early stage founders, so at the pre-seed seed stage. And although we have a few founders who are a little bit later, having already raised their Series A. We have about a quarter of startup executives with us, 20% HR professionals, another 10% who are finance professionals, which makes a lot of sense because that's the startups experts community. So thank you for sharing. That really helps me. So it looks like we have a mix of founders and executives with us. So I'll make sure that that I tailor the content appropriately, but feel free, if I'm using terminology that you don't understand, stop me, either throw it into the chat or just raise your hand or just interject, and we'll answer any questions. So some of this hopefully is lingo that you're familiar with, but if it's not, feel free to ask away. So with that, I'm gonna start the presentation and launch right into it. So let's see. Okay, there you go. So just a little bit about who I am. Let's see. So I have a 20+ year career that spans consumer tech in Silicon Valley, lots of marketplace companies. So my background is that I graduated undergrad from Wharton, and I know we have some Wharton folks here. Went into management consulting, that was 95 to 98. Knew I didn't want to stay as a consultant, wanted to figure out what to do next, didn't know, didn't have a clue. So of course, as many of us who don't have an idea of what we want to do, we go back to business school. And that's where I was at HBS from 98 to 2000. And while I was there, I noticed that the Web 1.0 boom was taking place in the Bay Area. And so I almost left HBS early to go join it, but decided to graduate. The Monday right after graduation, though, I moved out to the Bay Area and started my career at eBay as a PM. And my product career really spanned 16 years. So I was at eBay for 5 years during a period of hyper growth. And one of the things I realized about myself was that I love the early stage. I love the early stage company building, product building, team building, culture building. And so I decided that I was gonna, after 5 years at eBay, go early stage again. And I joined 4 different venture-backed startups, typically at the Series A. I was the VP of product at those startups. And then after a 16-year career in product, I decided I really wanted to do something different. I reconnected with an old boss from eBay who had just started as a partner at a mid-year network. And she said, hey, why don't you hang out with us here at a mid-year network? We have over 100 portfolio companies that we've invested in, and they could all use your product expertise. And so I started my venture career as an entrepreneur in residence, and then later joined a mid-year network as an operating partner. A couple of years in, that same ex-boss of mine, who was a partner at a mid-year network, she and I decided to spin out and form our own venture firm, and that was called Spero Ventures. And the thesis of our fund, which was about $100 million fund, was that we wanted to invest in companies that had impact at scale. So that there was no trade-off between purpose and profits. And so our thesis was that we invested in the things that make life worth living across well-being, work and purpose, and human connection. So I started investing in seed and early Series A startups at Spero Ventures. And really interesting, the fall of 2020, the Swimply co-founders had pitched to me. And as they were telling their story of Swimply, which for those of you who don't know, we are a consumer marketplace that allows pool owners to rent their pools locally and by the hour to folks in their local community. And during the pandemic, Swimply just completely blew up because people were cooped up at home. They wanted to do something COVID safe. They wanted to get outside their home, but they still couldn't travel. And all the public pools and beaches were closed. And so Swimply really hit lightning in a bottle and had hyper growth during the pandemic. And as they were telling me their story, it reminded me a lot of my eBay days of economic empowerment on the one side of the marketplace. On the other side of the marketplace, it was around bringing people together around joy and shared interests and passions and community. And so not only did I have the conviction to want to write the check, I did this crazy thing, which is I left the world of venture and I joined Swimply as their first real full-time employee and helped them close out their first institutional round of funding, which was a $10 million round at the time. And that's sort of what you see here on the left. That sort of summer of COVID, we did about 6 million in bookings. The following summer, we tripled bookings. So we did about 18 million in bookings. With that success, we decided, hey, let's go out and raise another round of capital and this was in 2021, money seemed to be flowing, valuations were really high. We thought that we would be opportunistic, even though we didn't need the money to go out and fundraise. And so we went out and we raised another $40 million round, and that was closed at the end of 2021. So I can speak from both sides of the table, both having been a venture capitalist and also going out and helping the founders raise this round of money. And so hopefully it gives you a little bit of background on me and sort of my expertise. So to really understand how to fundraise, it's important to understand sort of VC fund structures and their economics and how they make money. VCs also have to raise money too. They raise from what we call LPs or limited partners, and this could be university endowments, it could be family funds, it could be pension funds, it could be high net worth individuals, but these are investors into a venture fund. And they're expecting return on their money, right? So they could put their money anywhere. They could put it in the S&P 500, they can put it with hedge funds, but they do generally allocate roughly around 5% of their sort of big endowments to put into riskier investments, including venture capital. But because the money is tied up for so long, it's tied up typically for at least 10 years, because it does take these startups that we're investing in 10 to 12 years before before they might see a meaningful exit or an IPO. The VCs need risk-adjusted, sort of a high return on that capital. And so they are expecting the VC funds to return 3 times the invested capital. But that's really, really, really hard to do. So you can sort of see the chart on the right that half of the VC funds that ever form return less than the amount of capital that they invested. And it is really, really rare. So it's only 5% of VC funds that return 3x or more of the capital to their investors. And then about 45% return somewhere between 1 and 3x. It's really important to understand that there's something called power law returns in the world of venture capital. So for many of us, we've heard of the 80-20 rule, right? So 80% of something comes from 20% of your users. But in the world of VC, it's actually very, very skewed. So somewhere between 70 to 100% of VC returns are generated by the top 2% of companies. So it is really, really, really skewed. And really the game of venture capital is hunting for those unicorns, and I'll even say deca unicorns, right? So the Airbnb, the Stripes, the Ubers of the world that really can return 50 times or 100 times return on the money, because a lot of our VC fund partners know that there will be a startup failure rate of 90% or more. As you go out and raise money from investors, you should also try to understand the fund's thesis. So VCs don't usually go out and look at every single deal. There's just too many deals out there. And so they really do come up with a thesis and a portfolio construction strategy. So they'll pick a certain sectors, stages, and geographies in which to invest. So for Spero Ventures, for example, we decided that we were going to concentrate on investments in ag tech and ed tech, marketplaces, and also in climate change. So those were some of the sectors that we invested in. In terms of the stage, we decided that we wanted to invest in late seed, early Series A companies, and then we wanted to constrain ourselves to sort of just looking at deals in the US. So it's important to really for all of you to, as you're talking to different VCs, to understand sort of what is their investment thesis and sort of where, like what stage and what geographies they're investing in. With that, I'll just pause and see if there's any sort of burning questions, or if, Corinne, if you see any sort of questions in the chat, feel free to maybe ask 1 or 2 questions now.
One question just came in, which is so many definitions of seed. What is late seed? How would you define it?
Okay, yes. So I do have a slide on sort of the different definitions of seed and sort of what traction at different seed stages, whether it's pre-seed, seed, or late seed. The goalposts change all the time, but I do have a slide on that. But for Spero Ventures specifically, we wanted to write a $2 or $3 million check into a sort of $5 to $8 million round. And typically we would want to see $1 million of annual recurring revenue. So, so that to us was sort of what we defined as sort of a late seed company for Spero Ventures. But if you can hold that thought, I do have a slide that kind of walks through the different stages and typical valuations and what traction you need at each of the different stages.
Another question came in about preferences in industry, and you kind of mentioned where Spero is investing, but do you have any other thoughts on preferences?
I'm not exactly sure what the question is. Is that specifically for Spero Ventures? Was that?
It says, do you have any preference of industries to invest in?
Yeah, so for Spero Ventures specifically, we were investing in edtech, future of work, climate, consumer marketplaces. So those were our preferences. But every fund is going to have their own sort of preferences in terms of sectors. And so it is really important. And I have another slide around that to just do your research. And before you even talk to a VC, make sure that they're investing in your specific sector.
Perfect. You may cover this next one, which is the best way to learn the VC profile of the desired target. So that might be part of your next.
Yeah. So just an easy answer is one, go to the fund's website, and they generally do a good job at talking about sort of their sectors, stages, geographies that they invest in. And then you'll learn a lot by following the partners at these funds and seeing what they write about, because they will typically also tweet or write about their investment thesis and sort of preferences of when they like to come in. Okay, so let's just keep going, and then I'm sure more questions will come up. So, so if you're a startup, based on what I was saying before in terms of sort of the economics of VCs and what they're looking for, the big question for you to ask yourself is venture capital right for you? So just because you're looking to raise money doesn't always mean that you're a good fit for VC. So VCs, as I mentioned, it's a power law return business. And so they're really looking at companies that they believe can achieve billion-dollar valuations, or even what we call deca unicorns, which is $10 billion market caps. And they're okay if some of their startups fail, as long as 1, 2, or maybe if they're lucky, 3 in a fund reach that unicorn status. So VCs are really hyper-focused on growth, and they're expecting you to grow every year. If at the earliest stages, it's what we call sort of triple, double. So for the first couple of years, we want to see at least sort of tripling of revenue every year, and then as you get more mature, then doubling of revenue. But essentially, in 5 to 7 years, to get to sort of that magical number of 100 million in revenue, because at 10x markup, that will make you a unicorn, and that's what they're looking for. And not every startup can get there, and certainly not at that sort of accelerated time frame. And so I would say that venture capital is really appropriate for less than 1% of startups. But I know a lot of startups, keep trying to sort of go and raise that venture capital. But I'd really sort of dig deep and just make sure that VC is right for you. Because if it's not, there are alternative ways for you to raise money. You can bootstrap your own company and take out loans. You can get money from family and friends. There's also a group of angels that might not be looking at the same sort of requirements around exits, and so they might be a good group. And then there's certainly other alternative sources of capital, whether that's grants or debt or crowdfunding. So definitely investigate all of these other options around financing as well. Okay, so I think this is the slide that should answer the question that was posed earlier around sort of the different stages of seed, right? So I always like to sort of say that today's seed round was like the Series A 10 years ago. So I remember being parts of lots of Series A companies, and we didn't quite have the traction that is required today to raise a Series A. We also didn't quite have the valuations that today's Series A's sort of command. These numbers were taken, I think, in 2017, if I believe, and these are actually good benchmarks for today. So I would say the last 2 or 3 years, all of these valuations and numbers were like hyped up because there was so much money being pumped into the system. But in today's economic downturn, and I do have a couple slides at the end that talks about what's different between sort of last year's fundraise and expectations versus this year's fundraise and expectations. But I would say that, like, going back to 2017, 2018 numbers, it's a good probably benchmark for where valuations are sort of landing today. So if you're sort of early pre-seed, maybe you only have a prototype or you're pre-launch, you might want to raise a pre-seed round that's typically less than $1 million. And you might want to raise it on safe notes with a typical sort of valuation cap of $1 to $3 million. And your investors that you'd be looking to raise from might be sort of friends and family or angels, or even like joining accelerators. And then if you get a little bit farther along, so you're at seed stage, maybe you've launched an MVP version of your product, you've been out there for a few months and starting to sort of see growth in your numbers, you might then go out and raise a $1 to $3 million round. And typical valuations are somewhere between 3 to 10 million at this stage. So here, early stage VCs really start opening up to you, but I would call them sort of pre-seed or early seed VCs that you'd want to talk to. If you're further along, and there's sort of somewhere in between the seed and Series A was where Spero was investing in, we call it mango seed or late seed. It was sort of traction somewhere between sort of what you see here. But if you've gotten to sort of Series A metrics, right? So 5 to 12 million is sort of the typical raise at the Series A, valuations of 10 to 30 million. And this is when VCs and especially Series A VCs really start opening up. So these would be like the Greylocks, the Benchmarks, the Sequoias of the world. Those are what I would call sort of early stage VCs. And then of course there's growth stage. So as you get further along, you're looking at now a different set of investors. So late stage VCs who might have 500 million or $1 billion funds, and that's who you'd be raising from. And again, sort of higher expectations around raises and valuations. So hopefully that helps. And before I move on, any questions in the chat, Corinne, that's worth answering now?
Let's keep going for now, because I'm wondering if some of these questions will get answered.
Okay, sounds good. So when you know that you're ready to pitch VCs, right? So like if you're super, super early, I would say like stick with those investors that might be comfortable putting money in when you're really early, like at the concept phase or MVP stage, and that's angels, accelerators, friends and family. And there may be some pre-seed funds that would be comfortable coming in sort of pre-product. I would say that the vast majority of VCs, even ones that say that they're pre-seed, really want to sort of see a product and market with meaningful traction before they come in. And so a good sort of measure of if you're ready to raise from VCs is if you have product market fit. So what does that mean? I would say that Mark Andreessen has a really, really great blog post on product market fit. Like, when you have product market fit, you don't have to ask yourself the question. What does that mean? That means that press is like wanting to write about you. Like you can't keep up and you can't hire fast enough to keep up with customer demand. That like VCs are starting to contact you already because they're starting to sort of see your traction from the outside and that there's a buzz around your company, right? So I think any of that, if that's happening to you, is a good indicator that you might have product market fit. I would say that Swimply certainly had product market fit. It was a pandemic and people needed to get outside. As I mentioned, I would say like it was the hair and fire problem. Like they really, really needed this Swimply product, and and press just wanted to write about us. Every summer we would get like 1,000 or more press hits, and so that I would say, we did achieve product market fit. VCs also want to sort of see growth up and to the right, so they want to get in like generally right before sort of that inflection point, that hockey stick. So if you're sort of starting to see sort of indicators that like not only are you growing, but you're starting to hit that inflection point and hockey stick, that's when they would love to come in, and that's when I think you'd be ready to go and chat with VCs. If you're not there yet, I would say you might want to hold off on talking to VCs and just keep like buckling down and working on your product and traction. So how much traction you need depends on the type of company. And so, here's different types of companies, consumer transactional, typically e-commerce. Consumer audience might be like a social network or anywhere where like you might not be monetizing users right away, but you're just really trying to grow overall numbers of users. There's SaaS, software as a service, and deep tech. And so different traction that you need. So for seed, if you're a consumer transactional business or a marketplace, for example, you might be looking at $250,000 to $1 million in revenue before going out to raise your seed. Or if you're building a SaaS company, you might be looking at $10,000 to $50,000 in monthly recurring revenue before you go out and raise at the seed. Of course, at the Series A, you're going to need a lot more traction, a lot more growth, and a lot more revenue. And so, as I mentioned, for Spero, we were looking for at least $1 million of annual recurring revenue, which is kind of more towards like the numbers on the right. But at the true Series A, I think recurring revenue, 1.5 to 2 or even 3 million in annual recurring revenue, I think is sort of the new sort of Series A benchmarks. And I'll send out this deck afterwards, the slides, so Corinne can send it out to everybody along with the survey, so that if you want to click on any of these links, you can get a little bit more information as well. Okay, so the hard part though is how do you get in front of VCs, and also how do you get funded? So this was the numbers that I pulled from our first year as a fund when we had started Spero Ventures. So even in that first year, we reviewed 1,000 deals. So 1,000 or more deals hit our inbox as a first year fund. Of course, we can't talk to every single one of them. We screen out a lot of companies based on lack of fit around stage, sector, traction, geography. But the ones that we do choose to meet with sort of fit within the fund's thesis and hit the traction that we were looking for. And so we ended up meeting about 150 of those companies in the course of that year. Of those companies that we had the initial call with, we took about 25 through due diligence, and then we only ended up writing checks into 5 or 6 deals. So you can see and this is very typical. It is really, really, really hard to raise money. So at any time you go talk to an investor, you can assume that you're going to get 99% rejection rate, but that's okay. That's the name of fundraising. Even Swimply, with all the traction that we had, we got hundreds of no's, and certainly more no's earlier on. And then as we developed traction and revenue, we had a handful of VCs that were interested in looking at us more deeply and doing due diligence on us. If you're about to go out and fundraise because you believe that you have product market fit, you have the traction, and you are interesting to companies, my recommendation is for you to run a process. So a mistake that I see a lot of founders making is that they just get introductions to investors and they, and then they talk to them, but they spread out the process over the course of months, 6 months or more. And I would challenge that that's not the best way to run a fundraise. Better is for you to run a process, try to sort of build your investor list of at least 100 or more investors of where you will be, where you think you'll be in their top 1%, because your company fits their stage, sector, geography. Ideally, you know which partner is investing in your specific type of company. And there's lots and lots of lists out there that you can do your research and build your investor list. But ideally, you want to get all of these intros up front. And at the same time, so that you can schedule all those first meetings within the course of 3 to 4 weeks, because you want to sort of build momentum in your round and raise the money faster. So what I like to do, and what I recommend founders do is, early on, try to actually stack up the first week of meetings with angels or friendly investors, or ones that you can sort of practice your pitch with. Even try to lock down some early commits so that, like, when you go into a VC fund, you can say that I'm raising $3 million, but I already have $750,000 of angel money committed, and we're just looking to close out with a lead investor, because that sends a powerful message to VCs as well, that that you've already built some momentum in your fundraise. But try to sort of try to stack all your meetings and do 4, 5, 6 pitches a day, which is a lot easier to do these days, since a lot of the early meetings will be over Zoom. And fundraising is a process, and expect it to take at least 3 to 4 months. And so you want to sort of get that momentum early. For those VCs who are interested in following up and doing due diligence, etc., that process will span 3 weeks to even 3 months or more. But it will go faster if VCs sense some type of urgency in your round, which is you already have a lot of interest in your round. You already have a few partner meetings lined up, and try to set sort of expectations with VCs that the round is moving fast and that they need to move fast as well. But of course, you can only sort of set those expectations if it's true. And the best way of making sure that it's true is that you sort of do all of the fundraising in a concentrated period of time. Okay, and then what makes a great pitch or narrative? So I think, I would separate out sort of what is a great pitch and narrative to sort of 3 key questions, right? So, convincing the VC that your company will be the next billion-dollar company. So a lot of components within that. So that you have this sort of big vision for the world, and that the market for your product is big. It's in the billions. And I would say that, the market size that you're playing in should probably be $50 or $100 billion markets or more. That's really what, like, the Sequoias, the Greylocks, the top VC funds are looking for. And then also sort of the why now story. So, why now versus, that your company could have started at any period in history, but why now? What's different about the tech, the market, or the platform? And then, of course, convincing them that, that you have like a unique insight and that the problem that you're solving is one that's, that is a real problem where people's hair is on fire and that you have the unique solution to put out that sort of fire. Second question is sort of what's your proof, right? And this goes back to the traction that, that I was talking about, that you should have traction there. You should understand your go-to-market. You should have a viable business model and unit economics that makes sense. Especially as you're raising later rounds of capital, they really are going to start to look at sort of unit economics, and that's going to be important. And then why you? So, what is your founder market fit is what we call it in the industry. So, why are you uniquely positioned to win? What is, did you have the problem yourself? What is the unique insight that you bring where you're going to be the only person who could build this company? And then what is the team that you've assembled behind you? Because it is, I would say, more rare for a solo founder to raise money because to build a venture scale business, VCs know how hard it is and that you will need to surround yourself with strong co-founders and a strong team behind you to make your vision a reality. So hopefully that helps. And then, as you line up these meetings, say that storytelling is everything, practice, 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 practice with friends, practice with friendlies, with current investors, practice before you go out to a real pitch, and be prepared for any scenario. So like I've seen all sorts of things happen. You get into the VC's office and the tech just doesn't work. So you want to make sure that you're able to do your pitch with or without slides. And then, different partners have different styles. So my style was that I'd like to ask questions. And so you might go through your questions and I would interrupt and I'd ask questions. You might pitch to other partners who would just be silent the entire time and you're not getting any feedback loops from them. So just become comfortable in any scenario. And then of course, confidence impacts outcomes. So the more confident that you are, not only in yourself, but in your business and the numbers and the customer problems that you're solving, the more likely that you're going to get the VC excited as well. And other pro tips are to ask VCs at the end of the meeting, especially if you think that there's some interest in having from the VC in your company, is to have them explain their process and their timeline, right? Which is, what is the process like? How many, how long is due diligence? How many meetings and with what partners should you be expecting? What's the exit criteria before getting to a partner meeting? So understanding their timeline. And then of course, if you're in an accelerated timeline because you have a bunch of upcoming partner meetings or like a term sheet already lined up, you should communicate that to them too, so that they know to accelerate their timelines. And then follow-up is critical. So like in every meeting, try to take notes. If the VCs ask for any follow-up information, make sure you send an email later that night with all of the follow-up materials, answer any remaining questions that they have, and and always sort of understand what the next step is in those emails. Okay, so how do VCs value your company? So say they're interested and they want to get to a term sheet. I would say earlier in the seed stage, it's more art than science. But as you get later, they are going to look at like your traction, your numbers, and sort of just peel the layers of the onion to really dig deep into assessing valuation and applying multiples to revenue based on a series of different factors. So here's again sort of typical valuations that you might see at the different stages. Expect as a founder that you'll get diluted 20 to 30% at each round, and don't set your valuation so high that it's going to be difficult to raise enough round later. Okay, couple of last slides. So those that sort of typical sort of VC fundraising 101. I did actually last slide. And then I did add a couple of new slides more recently based on today's economic environment and sort of what the differences are. But as I mentioned, sort of be prepared for lots of rejections. You're going to hear dozens, if not over 100 no's. Don't let that affect your psyche. Practice self-care to manage the roller coaster of emotions. If you get to term sheet, understand sort of the different, what's in the term sheets. Typically splits out into economics and control. given the time, I won't go through all of that, but hire a good lawyer. They'll also help you understand sort of the term sheet, and then make sure that you reference your investors as well, because as they say, VC and founder marriages last longer than most husband and wife marriages. It's a 10 to 12-year relationship. So you want to make sure that you feel comfortable taking the investor's money. And so reference with other founders who have taken money from that VC and find out, if they would take the money again. Okay, so this is sort of the last two slides around sort of today's fundraising environment and what's different from, like, say, a year ago, a few years ago, which is sort of the environment where Swimply was able to raise their money. As we all know, stock market has crashed a bit over this last year. Public stock valuations are down 60 to 80%. It's a combination of different factors: the Fed pumping lots of money into the system, interest rates rising. When interest rates rise, the cost of capital rises, multiples fall, companies are able to spend less money on growth, and so their valuations will fall. And so the chart on the right shows you that even in a sort of hypothetical startup that's valued like a public company, even if when there was a 25% sort of decrease in the growth rate, it resulted in valuations that were down 75% or more. And you can sort of see kind of roughly the math that like takes these public companies down by that much over the last year. And of course, when public company comps fall, that extends to the private markets as well, because VCs don't want to like overpay for their investments either, because they're not sure if they're going to sort of make it up on the exit. And over the last year, we've seen more and more VCs sitting on the sidelines. You can see that chart on the bottom right there, which is a few years ago, or actually even just last year, like VC funding was at its peak, and it's fallen by more than 50%. As VCs sit on the sidelines, companies just don't have as easy access to capital like they did. So they spend less, growth slows, and that also leads to declining multiples for private startups that are going out to raise money. And so, I was most recently at Spero Ventures. I was in a couple of board meetings just this year where our VCs were telling us what they were telling every other company in their portfolio, which is, guys, it's time to buckle down, try to preserve runway. Don't expect to raise in the next year or two. Go and preserve runway to 2 or 3 or more years, and that just means cutting costs, and just trying to sort of extend cash as much as you can. But the good news for next year, VCs still have a lot of dry powder to deploy. There's over almost $300 billion of VC money out there that's sitting on the sidelines. And so there's predictions from some VCs that 2023 will start seeing a rebound. Although, I've heard other VCs that are a little bit more bearish, and they think the rebound might not happen until 2024, maybe even longer. So just be prepared for whatever scenario. And then finally, last slide. Let's see. Last slide. Okay, so in today's economic environment of uncertainty, sort of what's different, right? So, in previous years, like last year, it was like a growth at all cost mindset. It's just grow, 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 grow. No matter how you grow, just grow to raise that easy money that was sort of out there in the ecosystem. This year, and this happens with every sort of bear cycle, the VCs go back to the basics. They want to sort of understand your unit economics, that you're efficient on marketing spend or other spend, and that there's a path to profitability. So they're going to go back to all the fundamentals in terms of their investments. And so when you go out to fundraise, you want to make sure that you articulate a really clear plan for growth and the use of the capital. So whether it's new investments, new products, geographic expansion, but they want to be able to sort of understand the use of the capital even more than they ever historically have inquired about. And you want to also be honest in your discussions around sort of where the risks are, where things can go south. You should be obsessing over your burn and runway. So if you only have 6 months or a year's worth of cash left, you might want to start talking to your existing investors to like understand, different paths that you can take besides just cutting costs. Maybe you need a bridge. Maybe you need to get your co-investors or your investors to come back to the table with a bridge round before you go out and raise sort of that bigger round in a couple of years. Keep getting feedback from VCs. So like if you're able to get in front of VCs, whether you're existing VCs, certainly the easiest to get in front of, but like potential or prospective VCs in your next round, try to get in front of them and build those relationships, and also ask them what they would be looking to see. So what milestones they would want you to be achieving for them to be interested in investing in you when you go out to fundraise. Also start looking for alternative sources of cash and capital outside of VC. So that could be a round of venture debt. That could be, just even like looking to increase the revenue that you get from existing users by raising prices or other ways, of raising capital. Grants might be another option. So start looking for that to extend runway, and just know that it will probably take you longer this next year or two to raise money than it ever did historically, because VCs now are no longer pressured to write the checks. Like, they will take their time to diligence, and it won't be a sort of bidding war as it was over the last year or two. So they're sitting on the sidelines, they're waiting, they're taking their time. So just know that it's going to take you a lot longer. And so with that, I think that's the end of my sort of prepared presentation. If you want to connect with me, here is a bunch of ways to get in touch with me or to follow me. With that, I think we can also open it up for questions.
Yeah.
So I will stop the screen share.
I have a few queued up here. So the first is a question from Adam. And I kind of followed up and got more information. So he said, hypothesis, they prefer deep tech in a down market because of the longer time before go to market. So a SaaS company might have a harder time since they are expected to drive revenue in a down market. What are your thoughts?
So I think the question is SaaS versus sort of deep tech. So I was never a deep tech investor. We did invest in some hardware, and one of the lessons that we've learned is hardware is hard, and it just requires a lot of capital. Deep tech requires even more capital. There's a lot of money right now going into climate, and so if you're a company sort of working on sort of climate tech, I think there's a lot of capital right now, and those investors do know that it takes a lot of capital, it takes a lot of time to prove things out, and so the money is there. So there are certain sectors, even within this sort of economic environment, where because it's a hot sector, there's still money flowing, and you, of course, might not have a product or revenue for quite some time. Investors understand that, and they would still be very interested in talking to you.
Adam, does that answer your question?
Yeah, I guess just the opposite though might be true as well. Like if you're expected to get a lot of revenue now in a down market when budgets are cooling and people are trying to conserve money, does that make it harder for you to convince investors that you can go to market and get to that 100 million revenue?
Yeah, it's hard. I mean,
slow start.
Yeah, in this market, it's the best companies will continue to raise, but it's just going to be a much smaller pool. So last year, it was almost like it was just easy to raise, even if you didn't even, no, it's never easy to raise. Sorry, let me back up. It's never easy to raise, but it was easier than ever before to raise because there was a lot of dry powder out there. There was competitive bidding wars. Some VCs might have relaxed sort of their growth requirements or other requirements just to get in the deal. And this year, VCs are expecting as much growth as they were before. They didn't lower their expectations around growth. It's just that then they just are funding less startups. But the top 5 to 10% of startups will always get funding because they will be able to grow even in this environment. And of course, you've already heard, that back in 2008-9, some of the best companies that produced mega VC returns, like started during a bear economy. Airbnb, Ubers of the world, right? So you don't always need capital to grow if you do have strong market fit and the market is pulling for your product. So
thank you.
I'm going to let Momita, she had a question, ask it as well. Go ahead and take yourself off mute.
Yeah, hi. I had a question about valuation. So, from what I understood from the slides, is it like we project the revenues and then at every round it gets diluted with more questions, and eventually whatever number that we arrive at the end is the final valuation? Is that how it works?
Yeah, so it depends on the stage that you're in. So like again, the earlier you are, valuation is a little bit more art than it is science, but like for certainly the growth rounds, it is going to be based on multiples of revenue. And so stage stage matters a lot. And then typically founders do ask me, and I don't know if this is the nature of your question, of like, do I set the valuation or do the VCs set the valuation?
Yeah.
So at the pre-seed stage, you might, as a founder, because there's nothing to sort of value your company on, you might like want to understand sort of comps, and you might sort of set a valuation cap because you're generally raising on notes, not a price round. And so, understand sort of what the comps are. Go talk to lots of people. You can even talk to me about what the right valuation cap is. And you'd raise on a safe or in a note, friends and family or angels, with that valuation cap. But as you start getting like late seed, Series A, where investors are going to require you to price the round, and so they will often price the round for you. They'll generate a term sheet with the price of the round and all of the other terms. They'll, and some of the terms will be that they might want a board seat and participate in governance and being active in your company by advising and sending you, helping you with strategy, et cetera. And so those VCs will typically price the round for you and do all the work.
So you mean like for depending on the stage, so in the pre-seed it's more like so what I was not clear about, is it still like we have to name the price, or is it like the VCs do for the pre-seeds or the seed stages?
Pre-seed, you probably won't have a VC valuing your company yet because there's nothing to value. You're probably so early on, there's nothing to value. And so typically the founders will set a valuation cap on the note and raise on that that cap. But if you have any questions, just reach out to me afterwards and we'll chat through it.
Sure. Thanks so much.
So there were two questions that were similar to each other. What type of changes do you see in diligence requirements from one fundraising stage to another? And then on there, somebody said, we have been getting asked for a multi-year roadmap. We're seed stage currently. What exactly are the expectations in terms of level of detail?
Got it. Interesting. Okay, so for the first question, can you repeat the question again? I want to make sure I got it right.
Yeah. What types of changes do you see in diligence requirements from one stage to another?
Okay, great. So at the earliest stages, there's not a whole lot to diligence. And again, at the earliest stages, you're often raising from family and friends and angels, and they aren't sophisticated in terms of diligence either. And so pre-seed or early seed rounds, it may just be 2 or 3 conversations with an angel, and they'll be ready to write you the check. They might dig in, they might a little bit, they might do a few customer calls, but really they're trying to get to know you as a founder and convince themselves that you're the founder to be building this business. Because at this stage, you may or may not have a product to market, you may or may not have some traction, and any of the traction is just still going to be so early. So there's not a whole lot to diligence. Certainly by the Series A, there's enough to diligence, right? Because you'll have gotten to $1 million in ARR if you're a SaaS company. You'll have some customers, some big logos, some small customers. You might sort of have some early signs of some next layer down metrics, but there will be a lot more to diligence. So expect the diligence to take a while. I believe for Swimply, when we raised our Series A round, the diligence took about 6 to 8 weeks. But it could go longer or shorter depending on how organized you are with your data room, and the VCs will have tons of questions, and the more prepared you are, the more that you can get them the materials that they're asking for quickly to accelerate the diligence process.
Okay.
And
And
there
then,
was a second question.
yeah, so they've been getting asked for a multi-year roadmap at
Oh
seed
gosh,
stage. What exactly are expectations in terms of level of detail?
yeah. Well, certainly, the multi-year roadmap is a very interesting one, and not all VCs ask for that. I think that they're really trying to understand, it's like, okay, what is the vision you have for your product, and do you sort of know the steps or the milestones to get there, right? Can you articulate it, and does it sound plausible? VCs typically know that that whatever you set today, it's going to change in the next few years, so they're not going to necessarily hold you to it. But I think that they really want to understand sort of your thought process, that that you have an understanding of where you want to go and how you're going to get there, and the milestones that you're going to achieve around the way. And so the more sort of the more detail that you can provide in that roadmap, the more plausible it is for the VC. But I think that that's really what they're trying to ask for, less so the nuances of the details. Although some VCs might ask you for the nuances of the details. Really depends on the partner. Not all VCs are the same. That's one of the things I've also learned in this industry. They all care about different things and ask different things.
And that's one of the other questions, is how do you provide enough transparency without, quote, giving away the farm? So finding the right balance of giving enough information, but not too much.
Okay, well, I would say that it depends on sort of what stage of the relationship with a conversation you are in with the VC. So if it's sort of the very first call, right, you should be able to answer any question that they pose to you, but there's not going to be that level of detail. But as VCs start getting more serious about you, they're going to want to go through due diligence, and they are going to want a level of detail. And if you can't provide that level of detail, they're probably not going to be interested in investing in you. Again, think about this as a multi-year relationship with your VC. You're going to be partnering with them for the next 10 years. You do want to be transparent with them, and open the kimono and share all of the details, unless you think that they're just fishing for information and not that serious. But you can gauge that in your conversations.
All right, and then we have one more question. Where's a good place to start to look at some example cap table structures for various stages?
Okay, so cap tables. So there is a book on venture capital written by Brad Feld. It's kind of the Bible in VC. They go through lots of cap table examples. So I would get that book. But then if there's a specific question around cap tables, feel free to reach out to me too. Generally in the earliest stages of fundraising, the cap tables are very, very clean and easy, right? So you've just raised from like family and friends, et cetera. As you get later, and these notes start converting, because then now there's a price round, there's valuation, and there's more investors coming in, the cap tables get a little bit more complicated. So I think it really kind of depends on sort of the stage that you're at. But get that book. I forget the name of the book, but it's by Brad Feld on venture capital. And there's lots of cap table information, as well as information on term sheets and governance structures and everything that you need to know. It's the Bible for venture capital.
It looks like someone put venture deals.
Thank you. Venture deals. Thank
Okay.
you.
Okay. All right. We do have one more question that just popped up. And then everyone, I put a survey in chat, so please feel free to let us know what you thought of today's presentation. Show Ha a lot of love. For those of us very early stage pre-seed, do you foresee expectations to bootstrap further than previously?
Yeah, I would say yes. So again, VCs are sitting on the sidelines. They're kind of requiring more, expecting more, and so I was working with a founder recently. I don't know if he's on this call, but he's trying to raise a pre-seed round. We sent out a number of different emails to different pre-seed VCs to see if they were interested. Not a single VC was interested in taking the meeting. And so what I told him was, market's telling you to buckle down, continue working on your startup. Accelerators is a great place to land because you'll be able to get access to experts and to funders, but they're really gonna, for the 6 weeks to 3 months that you're with the accelerator, they're going to work with you side by side and, holding you accountable to building your business so that you get further faster. And then at the end, there's always those pitch or demo days where you can get in front of dozens or even hundreds of VCs and angels in their network. So right now in this market, if you're that early, definitely consider maybe joining an accelerator.
Very good. Well, everyone, thank you so much for joining. I'm going to go ahead and stop our recording.